Inflation is currently at 5.9%, so if you're making less than that, you're getting screwed in this money investing game. In this video, I'll talk about how most passive real estate and stock investors are getting screwed in this inflationary market, and how myself and my student has been making consistent 18 to 54% per year with our said and done strategy to help you reach your own version of financial freedom sooner. So traditionally, this is how real estate investor has been making money passively. First is through something called REITs. REITs stands for Real Estate Investment Trust. These are vehicles that big funds put together, and they will take your money when you buy their stocks, and they'll take those money and in return to buy bigger projects, and where you can just write your check at home, you can sit at home, and you make a profit. On average, these REITs are paying out 4.3% of dividend yield per year. What that means is that as long as you're participating in their company, they'll pay you 4.3%, just like the bank paying you an interest every year. Because the way the REITs is set up, there's very minimal appreciation. So really, the stock price is usually quite flat, so people are really just banking on a dividend yield to beat the inflation. But 4.3% of a dividend yield on average is still smaller than our current inflation rate of 5.9%. A second passive way for real estate investors to make their cash flow is through private lending. Private lending's return usually range from 6 to 12%. But I don't recommend that, especially in the current situation of the market. A lot of real estate investors who are amateur or even experienced people are over leveraged. And a lot of them are having their trigger rate. And a lot of the real estate investors are experiencing trigger rate. That means the bank are calling them, asking them for more down payment, or asking them to increase their monthly payment. So with the already really tight cash flow from real estate, now most of them are going to negative cash flow, and they're really banking on, in the short term it will be negative cash flow, but in the long term it will be okay. But truthfully, we don't really know how long we have to hold here. Now, the last option for passive real estate investor is to just buy a property and hold it for the long term. Traditionally, properties price goes up by 3 to 5% every year for the past 30 years. I know there's an anomaly for the past few years, but this is the overall average. So if you're only making 3 to 5% per year, you're not even beating the current inflation of 5.9%. So now that we discussed with the current inflation rate of 5.9%, it's difficult for passive real estate investors to find projects to continue to generate them cash flow. Why not we look at how stock investor can continue to survive in this inflationary market? So if we look at this chart here, this is the 20 largest company in 1989 comparing to 2021. Right from the 1989, you can see that out of these 20 companies, only 6 of them are from US and the rest are from Japan and Netherlands. Now in 2021, none of these companies from Japan or Netherlands, and most of these companies are from US. But I want to point out is that if you pause this video and look closer, none of these companies on the list of 1989 are still on the list of 2021. What that means is that within this 30 years, many things change. And if you're a stock investor who wants to hold stocks for the long term, you have to make sure you buy low and sell high and know when to get out and rotate to the next Apple, to the next growing unicorn, right? So if you're confident with that, it's totally fine. If not, you should learn about the next slide. So in this slides, we look at S&P 500, which is the best 500 performing company in the United States, arguably in the world. S&P 500 in 1989 was around 150 bucks. You know, when we took the screenshot, it's about the end of 2021, it's about 2200. So that means this S&P 500 actually 25x in 30 years. And that means you pick the best 500 companies. They will get rebalanced every year. If any company go bankrupt or come out, any new companies will get filled in again and get rebalanced every year. For picking any stocks, you're making 25x in 30 years. Not too shabby, right? So before I go into an introduce or said and done strategy that can make 18 to 54% consistently every year, I just want to remind you that if you invest in S&P 500, it has been returning 8 to 10% every year for the last 30 years. Now let's get right into my set and done strategy. Right? The benefit of our set and done strategies is that you don't have to pick stocks. You're basically collecting premium just like the casino owner or an insurance company, and we do not need to do any research on individual company. We're basically banking on the best 500 companies in the world. And the volatility is a lot lower. That means more certainty for your returns. And at the end of the day, you're letting the theta do the work for you. What that means is that you're just like an insurance company collecting the premium that you pay for your auto insurance or car insurance. Whether you make the claim or not, you do not get the money back. And now we're on the other side, so we just collect those premium, and we know our worst case and best case scenario, and continue to collect our fruit of labor. Now I know you guys are very curious. You guys want to see a demo of our set and done strategy, so let's get right into it. So we only use one ticker, that is ES. That's the future options of S&P 500. When I took the screenshot, ES price was at $37.82. I sold a $3,060 put options on ES. That strike price of $3,060 is 19% from the current index price. Okay, I make it to expire in 45 days. In return, I receive $11.50. Really, because there's some leverage involved, really what I receive is $575 USD. Now there's two types of scenario, because the stock could go up, go down, or stay the same. Now let's look at if the best scenario, right? The stock price or the ES price stays above 3060, which is my strike price, within or by the end of the 45 days, I get to keep all my premium of 575 USD. And if scenario 2, the worst case scenario, it doesn't even stay the same, it doesn't go up, actually go down 19%, go below 360, just like what happened during COVID, then, you know, first of all, the chance of that is really, really low. It really only happened during COVID, where the entire stock market dropped 30%, right? Now, if that really happened, what we could do is we can decide whether we want to take the small losses or roll our position, right? That means we're just buying more time for the position to go right. By the end of the day, if we're consistently making 18 to 54% per year, taking a small dent, a small stop loss of 3 to 6% is still better than holding individual stocks that might drop 50, 60, or 80%. This is a pure cash flow strategy. So if we're comparing buying individual stocks with our set and done strategy, here's how it's break down. Buying individual stocks, number one, you will have to have the ability to pick really good stocks. From my experience, and a lot of people's experience, is that if you pick 5 stocks, 4 of them will go up, but 1 of them will go down. And the one that goes down will drag down your entire portfolio. The second point is that if you're buying individual stocks and you have a very small account, it's hard for you to diversify. And the last point is that during any market downturn, if you pick individual stocks, it can drop anywhere from 10%, 20, 50, even 80% on really good stocks. I'm sure a lot of you guys have witnessed it. So you're really left with holding the bags during a recession. Now, if you compare that with our set and done strategy, first, you don't have to pick stocks. Second, you're basically using the underlying of S&P 500, so there's less volatility and more certainty for your return. And even if you have a small account, it's easily diversified because of the underlying is already 500 best companies. And also, you can start this strategy with as little as $5,000. Last but not least, during a market downturn, you can easily take a small losses or roll out your position, and you do not have to back hold any stocks that will go down 50 or even 80%. Now that I've taught you how passive real estate and stock investor can still beat the inflation and make consistent cash flow, you might be wondering, Cody, why are you sharing these strategies? If it's working so well, why are you sharing it? And that's a very good question. The reason I'm sharing is because I was once just like you who was struggling to make money. I was having 2-3 jobs at once, right? I was working as a full-time project manager, working 800 hours of overtime every year, and I was a day trader at night. When I'm not a day trader, I was attending a lot of seminars just to get ahead in life. And now that you have a chance to sit at home and watch this video and teach you exactly how this has been done, and so that you guys can get out of your 9-to-5 rat race and reach your own version of financial freedom. And hopefully you guys take all the profit and the time that you get back and give it back to the society. The way I'm doing it is I'm raising a lot of capital for Sick Kids Hospital and Mount Sinai, and I sponsor a lot of golf events that are raising awareness for very important matters. So thanks for watching this video. This is how you can get ahead as a passive real estate or stock investor in this kind of market to beat the inflation of 5.9%. If you like this video, make sure you hit that like and hit the subscribe. If you have any question, put it in the comment section below. I'll see you on the next video. Say yay.